What happens if the investor decides that they like the company that they invested a small amount in so much that they want to buy more of the company? Well, let's say that Alphabet pays $84,000 for 10% of Bailey. There's no significant influence. We use the fair value method. Total fair value method of Bailey at that date was 840. So 10% of that is 84. No big deal. They paid the fair value. However, then a year later, at the end of the year, the fair value of Bailey goes up to $890,000. Alpha's investment in Bailey is 10% of that. So now the fair value is $89,000 since we're using fair value method. So they make a journal entry that shows the increase in the fair value of their part of the investment is $5,000, and the investment itself goes up by $5,000. Okay, then on January 1st, 2021, a year later, they purchased 30% more of Bailey. Now they have 40%, now they have significant influence. They have to use the equity method. The fair value implication here, if you divide 267 by 30%, you'll find that the fair value is 890. They record their investment at 267. There's no adjustment between fair value and book value here. We simply say, okay, we've now paid $267,000 for our investment. So we had first journalized or recorded $84,000. We then recorded at the end of the year the increase in the fair value of the investment, and now we're recording the final fair value of the investment is $267. We paid it, it must be the fair value. Okay, so on 1/1/26, here's our balance in the account. On that day, the book value of the company is $715, and patents were the only thing that did not equal the fair value. Their book value was undervalued by $175, and they have a remaining useful life of 10 years. So if we look at the 100%, we have $715 book value plus the undervalued patents for a fair value of $890. 40% of that, 40% of $715 is $286. 40% of the patents is $70, and that's your $356,000. And keep in mind that annual excess amortization will be our share of the patents, which is $70,000, divided by their useful life of 10 years, or $7,000. If in 2021, the year that we gained significant influence, Bailey reports net income of $130 and pays a dividend of $50,000 at year end, then we're going to record that net income their net income increases our investment. So 40% of 130 will increase our investment, and the dividend, 40% of that will decrease the investment because it causes their retained earnings to go down. And the way we think about this is we own 40% of the other company's retained earnings. We do. Net assets is retained earnings because net assets are assets minus liabilities. That's equity, retained earnings. Okay, so equity in the investee income increases the investment, but we take out the excess amortization. That's the only trick here, that we have to remember to take out the excess amortization. And the receipt of the dividend decreases. So we have dividends receivable, assuming we didn't get cash right away, and investment in Bailey goes down right here. Investment in Bailey goes up by our share of their net income, the 40% of 130, which is $52,000, less the excess amortization, so $7,000. So our share of this, their income, is $45,000. And this is just if, assuming we did the dividends receivable, we would have to get rid of it. So then we have cash and dividends receivable going down. And our ending balance now, using the equity method, is $381,000. And that's it for this chapter.